Hey everybody, great class today, brand new, preparing for retirement. Before we get into this, I want to make sure I do my shameless commercials. fpfeaz.org. You can find our full schedule of all of our full classes, and we have the class on demand. So we've got every month a class of the month on demand ready to go right on this website. So you can register for classes, you can see all the topics for the year. We refresh and update and put in new classes every year. So lots of great stuff, different topics every month. If you have not found our YouTube channel, please go into YouTube, search for Planning Before Investing, subscribe to the channel. We've got over 280 videos and we have new videos every single week. So lots of great new content, lots of great new little mini educational classes on everything I can possibly think of, considering I got to do a new one every week. So lots of great stuff on there. And we've got new content coming that's pretty fantastic as well. If you want to learn more about us and our company, sesweb.net, sesweb.net is our website, and we are filling up all of this educational tab right now as we speak. Our full class schedule is on there as well, but we've also got our full classes, recordings. We're filling this library with all these different topics. So I've got full education classes, hour-ish long on each of them. And as we record them, just like this one, we're going to be adding that into the web page here. We've got YouTube playlists on here, lots of great topics, planning for volatile markets, preparing for retirement, even all the way to reverse mortgages, safe investments, every topic you can think of. Lots of little mini videos, little 10-minute, 20-minute videos, and then reports. I've got white papers and a whole bunch of other stuff. We're filling this one up right now. I think there's only 4 on here, but I've got 15, 20 that we've already got approved, and we're working on getting those put up on here as well. So lots of great stuff. And then certainly if you want an appointment with me, you can jump on yourinvestmentcounselor.com. You can book a free meet and greet with myself or anybody on our team. Always happy to help out anytime and make it as easy as possible at yourinvestmentcounselor.com. All right, so let's get into this class here. So preparing for retirement, this is my specialty. This is the only reason I exist. I love doing this. This is what I have all my experience in coaching and working with people transitioning into retirement. You've got to start about 5 years before you're planning on retiring, and you've got to start repositioning and getting ready for retirement. So we're going to talk about all the important elements, and that includes the emotional side of this and the things we need to address as married couples or as single people. There's a lot of things we got to think about. So we got to work on finances, but we got to make sure we have our eyes wide open as we transition into retirement. So that's what the idea of this class is. Let me get my little laser pointer out here. Nope, that wasn't the right button there. How about that one? Nope, that wasn't the right button there. There it is, laser pointer. All right, so let's get into this. If you are new to our organization, the Foundation for Personal Financial Education, fpfeaz.org is the website, is a nationwide nonprofit organization. I run the Arizona chapter, but my education is nationwide, worldwide, whatever we want to talk about when it comes to the internet. So the whole idea of this organization is to be able to provide financial education without the sales and biases you get in these fancy dinner seminars and other sales events that are out there. Hopefully you find this to be a different atmosphere and keep coming back for more. It's a different topic every single month. My background, I've been running the nonprofit for a little over 10 years. I have a master's degree from University of Arizona focused in finance. I own a local family of companies that includes a wealth management firm and a tax firm. So I do have practical working knowledge in virtually everything that we do education in, which is very important because the combination of taxes and wealth management and investing is really what's so important in this topic. Also, legal disclaimer, as per all of my classes, please understand that these are for educational purposes only. These are not direct financial advice in any way, shape, or form. Please use your CPAs, financial advisors, attorneys, whoever it is you need to help apply this to your situation. All right, let's dive in. We got a lot to talk about. Emotions, we're going to start with them. Some of us have more emotions than others. I've been known to be on one side of the spectrum. The reality is we have to control those as we enter and learn how to enjoy retirement. And going in with our eyes wide open becomes very important. Taxation, big frustrations in retirement. It's not coming out of our paycheck like we did when our W-2 came in. We didn't feel like we paid much in taxes. Now it's going to have to really be painful. You're going to have to write checks. We're going to have to figure out how this taxation changes because it significantly changes. And then living on our savings. That's not easy. Okay. Withdrawing, spending more than you make. That's not easy. We got to figure this out. So let's start with the emotions. Let's get the baseline down. Let's get an understanding of what we're dealing with as we're transitioning and heading off into retirement. So the first part, we have to mentally prepare for this. So I'm going to start with everybody needs to think of these things. Then I want to talk about married couples specifically. So when you are no longer working, what will be your purpose in life? And people laugh that off, but wait till you make that transition. Oh boy, you're going to have to figure that out. You're going to realize that there were things you were getting in the workplace that you're no longer getting anymore, and you might need it, especially the workaholics. Workaholics leave. They're like, I can't wait to get out of here. I'm going to go on vacation. And then a month later, they're twiddling their thumbs and they're driving everybody nuts. Okay. So be very careful about this. What is going to drive your life after work, right? So what does the idea of being productive mean to you in retirement? Do you have a honey-do list? Do you have this list of daily activities that you've got to get done? Are there bigger projects? Do you have hobbies? What is it that is going to get you up every morning, right? What's going to get you off the couch every day? Start thinking through that. What do you envision your daily routine and activities in retirement? Do you have grandkids? You can spend most of your time taking care of them. Are you going to travel all the time? Well, that's fine and dandy. You know, my parents will take 2 trips a year, but what are you going to do the rest of the time? And that's nice. So you have to think through these things. What are your daily hobbies? Not your, I'm going to travel. Oh, great. That's wonderful. That's going to take up about 4 or 5 weeks of the year if you're a lucky person, right? So we got to think about the rest of that. How does your financial situation align with what you want to do in retirement, right? Can you even afford what you want to do in retirement? Matching that up, and I'll show you how to do that. It's going to be very simple, easy math, right? So we got to know what we're going to be spending our money on and how much these things are going to cost us. What's a vacation to you? Is it 50 grand or is it 2 grand or is it $500 in gas? Next. What do you think a typical retirement day, then week, then month look like? And then start going out to the years. Where's your bucket list? Can you keep adding to that bucket list as you're taking things off that bucket list? What's your first year going to look like? What's your third, fifth, eighth? We got to start thinking through these things, and you always got to push it, push that needle. Make sure that you've got more and more things to do. That dangling carrot has to stay there. Now, married couples specifically, we have to openly communicate. Okay. So important that you're on the same page as you head into retirement, because the so-called gray divorce that's going on out there, 43% of 55 to 64-year-olds are getting divorced. 43%, right? There's a reason that this transition age in retirement has a high and elevated divorce rate. Are you ready to spend 24/7 together? Most people think they are, but they're not. It's amazing. Luckily I get to work with my wife, but that's only because it's only worked out because of lots of therapy. So it's very important that we understand that spending 24/7 together is hard for people that didn't spend 24/7 together all their lives. Maybe you got a glimpse of that in the pandemic. So sometimes I hear things like, I need to go back to work because my spouse is driving me crazy. My husband tells me to stop bugging him. He's retired now and just wants to relax. Well, look, these things are all going to happen. We got to make sure we work through these. So important to know, as a married couple, you're going to be spending 24/7 together, and you have to be prepared for that. The next part is, what do you imagine your spouse or partner doing in retirement? Hey, here's the crazy thing. If I sit down and say, here's what my wife envisions as her retirement, we're on the same page because we've been talking about it for 10 plus years. We've always talked about it because we found that that's one of those tricks that got us to work together, and just having a vision of our future at all times. So you have to start talking to your spouse about this. You do have to understand what's going on in their mind and what their idea of retirement is. What are the key areas that you're going to focus on together in retirement, right? We have to have a combined bucket list. I always say, make your own bucket list separately without talking to each other, and then go out to dinner and chat about your bucket list and create one that's common. All the things that you had in common that you want to be doing in retirement, start combining those. You also have to openly talk about your time apart versus together. Okay, my mom put limits on my dad's ability to go play golf. He would be out there golfing every day. But the reality is they need to negotiate the time apart and the time together. And my dad is a go person. He always wants to be going and doing something. So yes, they take a couple of vacations every year, but they're also exploring their own area. They live up in the Washington area, and there's endless things to go explore, whether it's go to a winery, or they just went to the Tulip Festival, or any of those things. So even shorter, smaller travel that they go enjoy. So making sure that we do have time apart, golfing or whatever the case may be. For me, it would be fishing or golfing or kayaking or mountain biking or any of those kinds of things. But then also having common things together that you're doing as well. So these are the things that I think are really super important that we take into consideration in that, 5 years before retirement. We start talking about it. We start trying to figure out what this looks like for us. Okay, now let's transition to the emotional side of money. Here's the reasons that we see our emotions change when it comes to money, right? First is you have more time to pay attention. It's really that simple. You no longer have a job with a paycheck coming in that pays more than your bills, right? You were working and spending less than you make, and you got used to that. Well, now all of a sudden you don't have a job and you don't really have a paycheck anymore. You may have Social Security, you may be lucky and have a pension, but the reality is you don't have something taking up your day. So more time to pay attention is one of the reasons right there. Now we're relying on our savings to fund the rest of our life. Holy cow, that becomes a big weight on your shoulders. And so you start looking at those accounts every day. We got to get through that. Remember, watching the stock market go up and down, up and down, up and down is going to drive you nuts. You can't go look at that thing every single day. The imbalance in savings versus income for some people is a huge reason that this is a problem. So we need to address that. Not enough income to pay base living expenses is an essential. You have to have enough base guaranteed income to pay those base living expenses. That is one of the big secrets of having an enjoyable retirement. The other very logical one is I don't know how long I'm going to live, right? Nobody knows how long they're going to live. If my watch had a little countdown on it that told me exactly how long I was going to live, this would all be a lot easier, right? So we know that that's a problem. And then what about paying for long-term care? That makes people worry. I got to preserve all my savings so I can pay for long-term care. Well, sometimes that's an irrational fear. Sometimes it's rational, but I look at it like this. I have a mother-in-law that's been in long-term care for more than 10 years at the highest level of care because she has Alzheimer's. Okay? You can't plan for that. You shouldn't plan for that. The very small percentage of our population does that end up happening to. The vast majority of people, 2 to 3 years is considered a long stay, and the vast majority of portfolios should be designed to be able to handle that later in life. Okay? But understand, a lot of people, a very large amount of people, don't spend even a year in long-term care. So trying to plan for the worst, okay, that's great, but then you're going to ruin your retirement, and it's not worth it. Most people would. There's plenty of people with lots of money out there. All right, so align your views on your risks. So this is how we begin dealing with our emotions. We talk about them, right? Nobody likes talking about their emotions, but we got to start. We got to start figuring out your tolerance, your appetite for risk. So the first type of risk assessment that you want to do is your appetite. It's your willingness to take risk. So think about your pot of gold, your money you have saved. You've worked so hard to build this wealth so you can go retire. Now, I want you to look at that pile of wealth and tell me how much of that money are you comfortable with in the market going up and down, and how much do you feel like you need to have safe, stable, marching along? Okay? That is important to assess your appetite for risk. Not what the book tells you, but what's going to help you sleep at night. That's what's important, right? Some people can handle 100% of their money in the stock market. Okay, so then the next part of this, we have to add on to that because I need to make sure that we don't have discrepancies here, right? Your tolerance for risk. Okay, now this tells me how much can your portfolio go down before you start feeling nervous, before you start panicking. If it's down 10%, 20%, 30%, 40%. If you told me 100% of the money can be in the stock market, but you start getting nervous at a 10% pull down, this is a problem. This does not make sense. We've had several times in the last couple of decades where the market's gone down 40%. And if 100% of your money's in the stock market and your portfolio is down 40%, you're going to start making very bad emotional decisions if you start panicking at 10%. If somebody tells me they want 100% of their money in the stock market, you better tell me you're okay with a 40% drawdown. So we have to match this up. This becomes a very important piece here to make sure that we're able to put together the portfolio that's right for you. But the other risk assessment here is driven by your situation, not your emotions. You can tell me you want 100% of money in the stock market, but you're going to also tell me you have a 6% withdrawal rate. That does not work. Your capacity is driven specifically by your need for your money. Your capacity is your ability to take a risk based on your situation. And that situation heavily depends on your withdrawal rate, frequency of withdrawal, and time horizon. Okay? So we have to make sure that the capacity for risk, somebody who doesn't need their money, Warren Buffett, he can have 100% of his money in the stock market, no questions asked. I have several clients that live on the income, the pension income alone that comes in. They don't even spend that. They have no need for their savings. They are in the same situation as Warren Buffett. They could have 100% of their money in the stock market. So we start with that capacity and we figure out, okay, well, where are we at on this? You need your money to survive in retirement, then you cannot afford to have 100% of your money in the stock market. Volatility and withdrawals equal losses. You have to be very careful, and you're going to see that math. All right, so what are we afraid of? Why can't we spend our savings? Well, it's because we're all genuinely afraid of running out of money. I mean, nobody wants to be in retirement completely broke, right? Okay, so the reluctance to spend money in retirement is very common and has nothing to do with how much money you have saved. Believe it or not, it's very common in all levels of wealth. Okay, so spending less than you make is a hard habit to break. We all know that, right? You spent most of your life spending less than you made. It's a discipline. You work hard at it. You The younger you learn it, the better off you are. Savings and growing is addictive. I watch people playing around in the market, and a good day in the market gives them a high. They love it. It's fantastic. They don't talk about the bad days, but they love the good days. It's addictive, growing just for the sake of growing. When I look at people and ask them who they're growing this money for, some of these people have no answer, and you can tell it's just a game. It's like people addicted to going to a casino. It's not any different. They enjoy it, and that's it. They don't have heirs. They just want to grow their money. For what reason? They don't know, because they're not going to spend it. Then there's the variability and unpredictability of an investment portfolio, right? If your portfolio is going up and down and up and down, you don't really have a target. You don't know how much money you have, so you can't really tell me how much you can spend. Okay? So we don't know how long we will live, and we know it. We don't know how much long-term care will cost us, if anything. We have to recognize that. Can't survive on income alone if savings runs out. That's the scary proposition that needs to be fixed. I will tell you, I've seen it over and over and over again. Income is what you need to pay attention to. Study after study shows retirees with large proportion of guaranteed income spend more money each year than retirees with larger proportion of savings. Meaning people with bigger incomes spend more of their savings than people with bigger savings. There's so many signs of this, and I see it in practical everyday world. People with bigger incomes are way more comfortable with their money in every which way possible. So here's the thing. More savings is not always the solution for somebody that's uncomfortable. More income typically is, because it reduces or eliminates the reliance on investment performance. Think about that. If you have enough income to pay your bills, and hey, even more for the fun money too, pay for your vacations, wouldn't that be fantastic? Then market going up and down doesn't bother you as much, right? That's the difference. That's a big difference. We're not relying on the performance of the portfolio. It takes the stress off of that. Now, fear of outliving savings. Well, wait a second. If I have enough income to pay my bills and survive, I'm not as afraid of running out of money. So I'm more free to spend it. Fear of funding long-term care. The bigger income I have, the less I need money for long-term care, right? If I just had somebody in here with $10,000 a month pension, $10,000 a month pension coming in every single month. And if long-term care only costs $8,000 a month, well, then there you go. You got it. You don't have to use your savings for that. Or hey, if it costs $12,000 a month, then you only have to make up for $2,000. Well, you have a house with all the equity in it that you're not living in anymore. Sell it, and $24,000 a year will cover a long time with the equity in your house. So more income solves a lot of problems, but I'm going to tell you it goes a little further. We do need to have balance. Okay, balance is the answer to a comfortable retirement. Balance. Okay, too much income. Now that doesn't sound like a problem, but too much income and not enough savings. I've seen people go into retirement like this. Now, it's not as bad as the opposite, but I will tell you, first of all, it's inefficient. You end up paying a lot more taxes. So money gets thrown away to excess taxation because you got money coming in that you didn't even need. So that's partially a small problem. Nobody likes paying more taxes than they need to. But then the other side of this is the big purchases, the second homes, the cars. These are all difficult things that you need to plan. And you have to be very careful with debt, right? So that becomes very important to manage those things when you have lots of income but very little savings. And then there's the other side of this, which is bar none the most uncomfortable. Not enough income but plenty of savings. I met a lady with $650 in Social Security. That's it. She didn't even own a house. Her rent was $1,200 at the time I met her. Her rent was more than double her income, to be real honest. I mean, after paying the light bill and everything else, it was more than double her income. That was so scary for her that she wouldn't invest her money. She would not invest her money. She had millions upon millions in the bank, earning nothing at the time. She was so afraid of running out of money, she was frozen. And I've seen this, and I've seen variations of this. And typically, when people are uncomfortable with their money, the first reason is they don't have enough income to pay base living expenses. And so that becomes important to address. You have to figure this out. Fear of outrunning savings is legitimate at that point. Afraid of market volatility, of investing at all. I can't lose a penny. So then it forces you into being way more conservative in your investing strategies. You're not free to invest properly. It forces frugality. So this is all a trickle-down problem when you don't have enough income to pay base living expenses. We have to address that. It's always got to be fixed. So what I need you to do to start working on these emotions, to start being someone who understands their finances, and the emotions get stripped away for good reasons, because a lot of people don't enter retirement without having enough. Now, you don't know you have enough, but there's just something in the cosmos. It's just like the vast majority of people, their bills they have to pay are typically covered by their Social Security. Not because they thought about it, not because they designed it that way, but because we're all afraid to have more bills than we have income coming in. It's just natural. So now being aware of your situation is going to help you look at these things more logically, which is going to help strip away some of these emotions, or at least calm some of these emotions. So sit down once a year, not every day, not every week, not every month, once a year, preferably at the end of the year in November time. Sit down and add up all your IRA savings and write it down. Add up all your Roth, write it down. Non-qualified, this is everything else, your brokerage, your trust accounts, all that kind of stuff. All the money that is not Roth or IRA, put it all right here. And then how much equity do you have in your home? Okay, I want those 4 categories written down. Next, safe investments versus risk-based investments. I want you to look through all your portfolios and look at all the investments, add up what you think is safe and stable, and add up what you think is risk-based, stock market-based. Okay, write those down. Obviously, cash is safe and stable. Most people put their bonds in the safe and stable. Any CDs, any annuities, typically all in the safe stable, not the variable annuities. Variable annuities are on the risk-based side. Okay. Then there's guaranteed income. How much guaranteed income? If it's just Social Security, write down the number. How much do you have? And then I want you to look through your budget. Tell me what your base living expenses cost you. Round numbers are fine. You don't need to count down to the pennies. And then how much fund money are you going to need for the upcoming year? How many trips are you going to take? What are your hobbies costs? You know, the fun stuff, going out to dinner every day, going to the movies, all those kinds of things. How much fun money do you need to enjoy your year? Do this budget every single year. Now, from there, I want you to do math. It's very easy math, I promise. Anybody with a calculator can do it. Some people without can do it. So here's the thing. All you do is add up all the savings, not the equity in the house. The cool thing about the equity in the house, that's the ace in the hole. We got that off to the side. We're not thinking about that. That's for later in life to help us fund long-term care if we really need it. Okay. So in this example, I have $1.4 million. I'm 65 in this example. And I say, how many years are you going to have in retirement? How many more years do you have left? In this case, I'm calculating out to 100. If you think you can't live to 90, then go to 95. Go 5 years beyond what you think you couldn't live to. Because if you're wrong, then this calculation is going to make you go broke before you die. Okay? So we want to reach all the way out to the, look, I figure if I'm 100, I'm not going to care if I'm broke or not. I'll be living with my daughter or something. It won't matter at that point. I'll live on my credit cards, or I'll sell the house and I'll have all that equity to live in. So the reality is you need to have a number that you're okay going broke at. Now, hopefully that's somewhere before you go broke, or somewhere before you, hopefully you pass away before that end date there. So in this case, 100 years old, 35 years in retirement. So 1.4 million, here's the math, divide it by 35. It's that simple. How many years in retirement, divide that into how much money you have, and that tells you how much you're allowed to pull out this year. Okay, just this year, not next year. Has nothing to do with next year. Has only to do with this year. And if I'm refilling my bank account for next year, because that's what I just did my whole budget for, I looked at it, what are my expenses, what am I going to need for next year? We're doing all this to look at what we're going to do for next year. So this tells me I can pull out up to $40,000 and I don't have to think about it. If I'm pulling out less than $40,000, I don't have to worry about running out of money, because I got 35 years of $40,000 every single year. Okay, so it's that simple math. And then you want to judge, the overall budget, then let's add your guaranteed income to it. So 40,000 withdrawal from savings, $48,000 from the guaranteed income, and that equals $88,000. Now, if my desired income, remember that bucket of bills I need to pay and fund money, if that's less than what my resources will provide, we're good. Right? If your resources exceed your desired income, simply don't overspend. That's the obvious one. Don't go spend $1 million. Don't go buy a Ferrari. In this case, you can't afford a Ferrari on $88,000 a year income. Don't do that, right? So don't overspend. But then your mantra for your portfolio is don't lose my money and try to keep up with inflation. And as you're going to learn, losses are not turbulence. Those are two different things. Losses are speculative investing, buying dumb investments that go to zero. You have no reason to do that at this point. You have enough money. Just don't lose it. Okay? And have a plan when the market's not doing well. Have investments that don't lose money. That's simple. Do the best you can to don't lose your money and try to keep up with inflation. That's all your priorities are. If this math works out right, that's all you should be doing. Next thing. Okay, if your desired income exceeds your resources, meaning let's flip-flop this. Let's say I needed $100,000 to enjoy my retirement. Well, then you have to go fix your problem. Okay, you need to increase income or decrease bills. That's the reality of it. You need to work longer, save more. You need to wait on Social Security. You need to decrease some of your bills. You need to do something to fix that, because anytime I see somebody where this math doesn't work out, yeah, they're uncomfortable. They are. It's their emotions. They're looking at their situation and now they're relying on their portfolio to grow every single year. So a bad year in the market, we got a problem. We're panicking. Okay, very important this math works out. And we're going to redo this every year. So here's the thing. Think about this as a very dynamic calculation in reality. I don't want fictitious growth. I want real growth. So next year, a year's gone by, whether my portfolio grew or lost, reality happened. Okay? So if it grew and I have one less year of life left, then I'm going to be able to pull out more. It's that simple. And that's how we keep up with inflation. So don't lose your money. You can be a little more conservative once you've achieved enough. Now, there are reasons that we're going to do this a little differently. For some people, their priority is to give their money to their heirs as much as possible. Well, then growth is going to be more important, right? So everybody's going to be in a different situation. But if we're trying to fund our retirement and we have enough for us to enjoy our retirement, don't sacrifice that, trying to reach for more and more growth. Okay, you're going to recalculate this every year, and it is going to be using reality, and it's going to put some guideposts on what you're allowed to pull out of your portfolio without having to worry about running out of money. Now, simplify the flow. Okay, so we're going to reach into our savings and reach into our investments and refill our savings. We put some guideposts on how much we can pull out of our savings. So think about it in 4-bucket term. Okay, not the buckets in the books. No, it's a whole different system. This is all about being as efficient as you can be with your situation. And I want you withdrawing from your portfolio once a year. Okay, so your checking account has your Social Security, your pension, maybe you've got an income annuity, any of that type of stuff. The regular monthly paychecks coming into your checking account, you're paying your bills out of there. Every time you need more than what your income covers, you reach into your savings and you pull the money out and you spend it. And then once a year, I want you to refill that savings account from your investment portfolio. And I want you to have the separation here. Separate your safe investments from your stock portfolio. Okay, you need to know where to reach into if the stock market's not doing well. If the market's been going down for 3 months, 4 months, then you want to be able to reach into your safe investments to refill. And instead of making this decision every single week, every single month, you're only making this once a year. You're refilling your savings account to have 1 year's worth of fund money and a cushion that your income doesn't cover. This will help you make better decisions. When the market's doing well, it's rocketing upward, you're going to pull from that portfolio. You're going to take some of the profits off the table, lock in those profits. Look at it that way. Too many people just pull from their safe investments and that's it. No, you pull from the stock portfolio when it is doing well. It's counterintuitive for some people, but it's mathematically the best thing you can do for yourself. And then when the stock market is not doing well, don't touch it, cut it off, and go and pull from your safe, stable investments. That's what we should be doing. That's the flow we want to do every year. Now, let's talk about taxes. Taxes change in retirement. This is so important we understand some of the basics of taxation, especially in the first, within 5 years of retirement, because we got to make sure we create a plan that's efficient for our own situation. And just like learning how to save early in life, we also need to learn how to be efficient as early as possible in our retirement. Okay, so IRA money, there's a little crosshair, there's a little target on it. Okay, everything in there is taxed as ordinary income. We have to get it out. And the question you're going to ask yourself every day after you retire, once you reach 59 and a half, you're going to ask yourself, how do I get money out of that account, that IRA, that little pile of money? How do I get it out at the lowest amount of taxation possible? Period. That is the question you're going to ask every single time. Okay? This is your heirs' least favorite money. So you're going to look at this every year and you're going to pull from there every year because the more you spread it out, the less taxes you're going to pay. Okay? Roth. Everything's tax-free. This is your heirs' favorite money. If you want to leave money to your heirs, this pile of money is the best pile of money out there. Your heirs are going to get this and get 10 years to grow this money completely tax-free. And then when they take it out, it's still tax-free. It's fantastic. The IRA, they're all screwing these things up. Nobody knows the rules. They're just pulling it out and paying huge amounts of taxes on it because they don't know what to do. They don't have advice. They don't have good advice. Okay, so important to understand that if we can get the money over to Roth, that'll be a good thing if you care about your heirs, because your heirs aren't going to make good decisions with it. We see it over and over and over again. Even when they are told what to do in the best way, they still cash it out and go buy a Ferrari or a Corvette or whatever. So everything's tax-free. Growth, income, withdrawals, no tax consequences. This is a great advantage you're going to have. So alternative investments like publicly traded REITs, MLPs, closed-end funds, these all are terrible on taxation. Well, they're perfectly fine in here and can be very useful for yield portfolios that create a lot of passive income, in this case, tax-free. Okay? The weird thing that people don't seem to understand is losses hurt most here. Okay? You don't get to write off a loss. If you invest $100 and it went down to zero, you don't get to write off the taxes you paid on that $100 because you paid taxes on that $100 when you put it into that Roth. Whereas the IRA, we didn't have to pay taxes on that $100. You lose that $100, there's nothing to write off. We didn't lose the money we paid that taxes on. So we lost all our money on taxes that we paid on taxes on the dollars we put in there, and then we lost the investment. And because it's in Roth, we don't get to write that off on our taxes. Whereas all that other money, we get to write it off on our taxes and take advantage of it. So Roth losses are a bad place here. Look, nobody likes losing, but don't purposely get speculative to the point where you have investments going to zero. It just doesn't make sense in this part of the portfolio. This is a great hedge against higher taxes and inflation. So meaning a long-term investing, right? We're going to want this for later in life in most respects. We're going to want to give this to our heirs. So we want to be doing long-term growth investing, not speculative investing. Then there's this after tax, everything else. This is your trust money, your brokerage money, whatever you call it, that's fine. As long as it's not IRA and not Roth, this is everything else. And every choice you make here comes with different tax consequences. This is the scary one here. This is where we can make the biggest difference on your portfolio and your efficiency. Interest, non-qualified dividends, short-term capital gains, these are all taxed at full income tax rates, and we can control every bit of that. We can control our choice of where to put this money and how to invest it, which controls every bit of this. Capital gains, step up upon death. People that aren't going to touch this part of the portfolio should be doing long-term buy and hold investing, because as it grows, when you pass away, the cost basis steps up and nobody pays those taxes. We should be investing differently based on your situation to minimize the taxation and create the efficiency, which creates much more wealth left to our heirs in that case. Municipal bond interest, long-term capital gains, qualified dividends, these are all tax advantaged, taxed at much lower rates or at zero. So we need to make sure we're maximizing the use of these in this part of the portfolio because they're useless everywhere else. Tax deferred does not avoid taxation. So remember, when you use an annuity, somebody sells you on an annuity as a tax deferred vehicle, there has to be a plan on the backside of this. Great, that's wonderful. I don't have to pay taxes now on the growth. But when am I going to pay taxes on it? That's the question you should be asking. There's nothing wrong with using annuities in any way, shape, or form, but using it solely for tax deferral in this part of the portfolio, you got to have a plan for the other side of that. That's just like creating more IRA money that you're going to get forced to get taxed on all at once. It just doesn't make sense. We're now retired. We're in lower taxation. We don't want to defer taxes, most of us. Now, I've got clients, I've met plenty of people that are in the high taxation world in the 30s. Yeah, defer, I get it. But the vast majority of us get sold on things because they're gimmicks. People get sold on municipal bonds all the time when they have no need for them whatsoever. So understand that we got to be careful. Taxation can't be the only decision maker in an investment portfolio. So then how are we going to use this? Okay, everything in your IRA is taxed as ordinary income. We're going to be forced to withdrawal. And when I say withdrawal, what this means is actually selling the investment, taking principal out. It's selling the stock, not taking just the yield, not the interest or the dividend. No, it's actually selling the stock. It's dipping into the principal. So we're going to be making withdrawals on here. We're going to be forced to. Required distributions are going to force us into this. Okay? And Roth conversions, well, that's not really selling anything. That's not withdrawing anything. It's just moving it from an IRA to a Roth. I can take, 100 shares of QQQ and just move it over to my Roth account. I don't have to sell anything. So that's a different function as well. And then here's those RMDs. We're going to be forced into taking an increasing amount out every single year once we turn 73. Eventually it's going to be 75, and who knows how many more times they're going to change that. So this is how we're going to be using our IRA. Now, Roth, everything is tax-free, and everybody's going to look at this differently depending on how you need your portfolio. First and foremost, if you care about money going to your heirs, this is the money that's earmarked for your heirs. Grow this long-term growth, and that's what you'll do, period. Now, if you're going to use it for yourself, growth for later in life, great inflation hedge, great for higher taxation later in life. I'm all for that. I don't have a problem with that. But too many people say, oh, I can't touch that. Oh, I can't touch that. Oh, I can't touch that. And they have this beautiful Roth account with no taxation, and they never utilize it to avoid higher taxation throughout their life. And then they pass away and it goes to charities. Well, that's the worst thing I would ever say to do. You should not have Roth money if you're just going to leave it all to charities. That is really bad. You chose to pay taxes on that money when the charities could have received it and nobody would have paid taxes, right? You can give IRA money to charities and nobody pays the taxes. So why have Roth if you're just going to give it all to charities? So here's the thing. I want you to use this account. If you're not leaving it to heirs, then you're going to use it. So first, you're going to create yield investments that pay out dividends and interest and all those things that give you money without having to sell an investment. Okay? That's a nice little passive income. And year to year, if you didn't need it, then you reinvest it. Then you go to the next year. Did you need it to refill that bank account? Nope. Okay, reinvest it. Then you got a bigger year. You got a car coming up that you're going to have to buy. Ooh, I need a little extra money. Great. Just so I can avoid the higher taxation, I'm going to take all that yield and use it to help refill my bank account. So there's those strategic withdrawals to avoid higher taxation. So we're going to adjust how we're investing in the Roth based on a situation, based on managing your taxation year to year, because you're only making a withdrawal once a year. You're refilling that bank account once a year. And then here's all that after-tax money. And again, I can't say this enough. Every choice you make there is going to cause different taxation. We have to control this. We have to understand this. If your advisor doesn't understand taxation, they shouldn't be advising somebody that's heading into retirement, period. Okay? They have to understand taxation. Every decision they're making in there is going to cause taxation. So, tax-advantaged income, qualified dividends, long-term capital gains, municipal bond interest. Okay? We're also going to be doing strategic withdrawals of principal to avoid higher taxation. Again, that car or maybe a second home, or there's lots of things that come up through life that we may need a higher amount of money. So strategic withdrawals and the passive income, I call this passive income. Okay. All right, so let's look at these tax brackets. 65 plus year olds. If you're under 65, that's fine. You're just a little less on each of these buckets. You'll see that coming up. Not a big deal. So if you're over 65, your standard deduction is 17,000 single, 33,000 married. Okay. Then you have the 10% and 12% buckets. These are green because these are considered low taxation. Okay, then you got the gray area, 20% taxation, 22 and 24. Okay, anything over 130 married goes into the 22%. Anything over 239 goes into the 24. We pay one bucket at a time. Here are the tax-advantaged tax brackets. This is where your long-term capital gains and qualified dividends are taxed. Notice when you're in the 12% tax rate, you're paying 0 here. Notice when you're in the 20+% tax brackets, you're paying 15 here. And then when you're in the 30s, you're only paying 24 and 18. Okay? They're very tax advantaged. You're going to pay less taxation on qualified dividends and long-term capital gains. So how do we prioritize using what when? Well, the first thing is if you're in the 12% tax bracket or less, then full taxation is fine. We're going to do some Roth conversions, some IRA withdrawals. Purposely, we're going to pull from IRA. As long as you're within 130,000 married, 65 single, we're okay with things like interest and all the income you can't control, your pensions, Social Security, those income annuities that you've triggered. Full taxation is okay. Look, if we can choose to pay less, that's great, but I'm okay with it here. Now we start focusing in the 20+% tax brackets. We're going to focus on the tax advantaged and tax free. This is where the qualified dividends and long-term capital gains, municipal bonds, Roth withdrawals, we're going to make sure that we're maximizing the use of that stuff once we cross over that 12% line. Once we get more income than 130 and more than 65 for a single person. And if you're all the way up into the 30+% tax brackets, then just defer. Let your heirs pay taxes. All right. So that's the mantra. That's it's all gray. This is all just meshing together, but this is where these become priorities. Okay. All right. So then what do we do every year? At the end of every year, there's a simple calculation you can do. And I'm going to use the 12% tax bracket, but you can use the 22%, the 24%. You can use whatever tax brackets you want to maximize. Okay. So we start with the 12% tax bracket. Maximum single is $48,000, married is $96,000. So how do we get to those bigger numbers? Well, standard deduction, 30 for a married couple, 15 for a single. And if you're over 65, you get the boost, you get the extra. All right. So that's where we came up with the ordinary income of $130,000 for a married couple before you have to worry about paying 22% taxes. 65 for single people. You go over that, you're going to pay 22. You stay under that, you're at 12 or less. Okay. So then what do we do with this number? Well, we go through and do a quick math. Just some addition and subtraction. That's all we got to worry about here. Okay. So we take that big number, 130, we subtract out 85% of our Social Security. Okay. Because not all of our Social Security is taxable. Subtract out any pensions that you have, subtract out any interest income that you have, and any other forms of income, including qualified dividends and long-term capital gains. So subtract out all your income, and what you are left with is what you can convert to Roth from your IRA, or simply withdraw from your IRA for the next year. Okay. So here you go. If I was married and had $100,000 worth of income, I now have $30,000 I can pull from my IRA and do a little Roth conversion and only pay 12% taxes. It's that simple. Okay. And we're going to do that in November every single year. That will tell us how much we can pull out of our IRA and either convert to Roth or use it to refill our bank account for the upcoming year. So let's see how this math works together here. Here's a married couple making $102,000. Okay. Only 85% of the Social Security is taxable, $36,000 all, the IRA and pension income, $30,000 in qualified dividends. There's the standard deduction, over 65. So the taxable income went from 102 down to 63,000. Okay, all the deductions right here, and then only 85% of Social Security. That's what changed it. Next. The cool thing here is the qualified dividends. We subtract the qualified dividends and we're left over with only $33,400 of ordinary income. And the first $23,000 was taxed at 10% and only $9,000 was taxed at 12%. So very little of this income, of the 102, only 33 was taxed at full tax rates. And then this is the confusing part. We start down here where we left off up here. We start on the qualified dividend long-term capital gain tax brackets where we left off on the ordinary income. So we had 33,000. We start at 33,000. We still have plenty of room for the 30,000 in qualified dividends to be taxed at 0%. If I had 96,000 of ordinary income, then the qualified dividends and capital gains would have got pushed into the 15% tax bracket, but I didn't. So this is a married couple only paying $3,500 in taxes on $100,000 worth of income. Big difference. Now, what's crazy is I see people in this situation all the time, but instead of qualified dividends, it's a whole bunch of interest coming in. So that $30,000 in interest gets moved up here and it's charged 12% taxation, and it completely changes the numbers. The power of qualified dividends or municipal bond interest is the fact that it's taxed at 0 and used properly. this can be a very powerful part of your portfolio. Okay? It has to be used properly, though. Very tax efficient situation there. All right. The only other hint or gift I have for you, if you don't know about this, is if you're 70 and a half and you are already charitable, you already give to church or charities, okay? Then at 70 and a half and forevermore, you will only give from your IRA. You call the IRA, you say, hey, send my church $5,000. As long as it goes straight from your IRA, straight to the church, it's eliminated from your taxable income immediately, and you are effectively getting the standard deduction and every penny of that gift to the charities. Okay? If you don't do it this way, then you have to itemize, and you're still going to take that standard deduction and get no benefit of this, most likely. Okay? So that's why you're going to always give from your IRA from here on out. Now, let's talk about this living on savings. This is so difficult for a lot of people. There are 3 types of income, and there are a very important distinction between each of these types. The first one is guaranteed income. This is income that comes in whether you have savings or not. The paycheck keeps showing up. This is your Social Security, your pension, any income annuity that has guaranteed income to you. These will all pay you whether you have savings or not. Passive income. This is not dipping into principal. This is dividends, interest. This is the yield you're getting from your portfolio without having to sell an investment. Okay? This is passive income. Sometimes it's a little more, sometimes it's a little less. When interest rates are higher, you get more income. When the stock market's high, the dividend rates go down, believe it or not. So we've got, 2% dividend rates these days. It's crazy. When I can get interest of 5-6%, you're only getting 2-3% in dividends. Unless you move up and get real specific, you can certainly build a higher yielding portfolio. And then there's withdrawals. Withdrawal income. This is in excess of passive income. The dividend and yield wasn't enough. Now you need to sell the investment. Now you need to cash in some of the principal. Withdrawal investments. Okay, you need that for things like required minimum distribution, buying a car, going on big vacations. Anytime your need for money exceeds the passive income and the guaranteed income, we have to be ready for withdrawal income. Now, certain investments specialize in withdrawal, certain investments specialize in passive income, and other investments give you that guaranteed income. Okay, so we have to know that distinction when we build an income plan for you, and we have to have the flexibility for all the unknowns. So now, spending more than you make, just flip the switch, no problem. You spent most of your life spending less than you make. Then you hit the switch and you go spend more, right? It's that easy. But the problem is the math, okay? The math acts differently in retirement as opposed to your savings years, your wealth building years. Okay, so the dangers of a volatile market. Let's talk about this. Volatility, is it a good thing or a bad thing? It depends on the phase of your life. Let's start with $100,000. Let's lose 50% of it just for fun, right? So you had 100, you lost 50%. Now you only have 50,000. How much money do you have if you earn the same 50% right back? Market went down 50%, up 50%. How much money do you have in your account? Some of you just went cross-eyed. You had 100,000, you lost 50%. 50% of 100,000 is $50,000. Okay, so now there's 50 left in the account. Now you earn 50% on $50,000. That's only $25,000. You add $25,000 to the account, you only have $75,000. So although you earned the same percentage back, it was on smaller dollars. This is the math that works against us. We have to be careful with this. So let's do a break even here. In the preservation years, you're not putting money in, you're not taking money out. If you took zero out, how much do you need to earn to get back to $100,000? So you had 100, you lost 50%. How much do you need to earn to go from 50,000 back to 100,000? That's the easy math. You have to earn 100%, right? 100% of $50,000 is $50,000. 50 plus 50 is 100. You got your money back. You broke even. So every time you lose 50% in the stock market, which doesn't happen very often, 40 does, but 50 is, pretty aggressive portfolio might lose 50. But it doesn't happen too often. So you lose 50%. You have to wait till you earn 100% before you break even. Holy cow, that doesn't seem fair. It makes people go mad. It does not seem fair. Well, here's what was happening in your wealth building years. That 401k, they kept taking money out of your paycheck. So the volatility up and down, up and down. When they were on sale, when they were down, you were supposed to keep putting money in there. So here, we put 10,000 into the account. Okay, so we had 100, we lost 50%, we only have 50,000. We put 10 in, now we have 60,000, but our break even moved up to 110,000, right? We invested 100, then we invested another 10, that's 110,000. So how much do we have to earn go from 60,000 to 110,000? 83%. And I don't expect you to do that math, but I want to make sure you understand the results of this math. Did you help or hurt yourself by putting money in? Here's an easy way to answer that. Would you rather have to earn 83% to break even or 100% to break even? Hopefully that's the aha moment. I get it. I would rather have to earn 83% because I'm going to break even quicker. And now I have more shares and they're all individually growing. So now the growth, the wealth building explodes. This is how we built our wealth. We kept putting in. Dollar cost averaging is one of the fancy things that people talk about. That's the math that's going on here. We want to put in when markets aren't doing well because it's going to help us recover faster and build our wealth. Okay? So we take advantage of volatility when we're in our wealth building years. The next part is retirement. Now let's look at what happens when we do the opposite. We had 100,000. We lost 50%. We have 50,000 in there. We take 10,000 out. Now we only have 40,000 left in this account, but we only have to grow enough to get back to 90 to break even, right? We invested 100, but we took 10. So to break even, we got to get back to 90. So how much do we have to earn to go from 40,000 to 90,000? How much, what does the portfolio have to go up as a percentage for us to go back to breaking even? Holy cow. We exponentially made ourselves worse. Okay? By taking 10,000 out, we cost ourselves an additional 25% growth. And again, that's not earning back the 10,000 we took out. That's just getting back to $90,000. Okay? So we have to earn 125% before we break even now. This is why the math is so important to understand. We cost ourselves an additional 25%. This shows you that losses hurt more. Losses hurt more. Taking out hurts more than putting in helps. Taking out hurts more than putting in helps. Look at this. This saved us 17% growth. This cost us 25% growth. Taking out hurts more than putting in helps. We need to know this. This is the cardinal sin. When the markets are down, don't ever pull from that part of the portfolio. Have a plan. Have a place to pull that didn't lose a dime. It's the only reason that safe, stable investments are needed in a portfolio. They can be wanted, but it's the only reason they're needed. So you have a place to pull from when the stock market's not doing well. So maybe you've heard about these order of returns. Maybe it's a little confusing, but all this math I just talked about relates to the order of returns. In your wealth building years, when you learned about finances and investing and how to budget and how to spend less than you make and become a good saver, order of returns didn't matter at all. It didn't matter at all. I can prove it. Here's the S&P 500 starting in 2020 going back to 2000. I call this investment volatility later. We earned 15, then 30, then we lost 6, then we earned 19, then we earned 9, then we lost 0.73, then 11, so forth and so on. That's the order that we got our returns. Here's volatility earlier. We hit 9/11 in 2008, and then we rocket launched. Believe it or not, this shocks people. The S&P averaged 4.61 in that time period annually, which seems nuts because we've just averaged for the last 15 years way over 10%. So that kind of shocks people. You add that decade, the lost decade of investing, 2000 to 2010 in there, and it really hurt the average. So here we are averaging 4.61 annually. In this case, we actually earned 4.61 annually. And guess what? I put 100,000 in all 3 of these investments, and they all ended up in the exact same place. We have 257,000 in all 3 accounts. The order of returns didn't matter at all. The average represented the average for both those portfolios. Let's change one tiny little thing. Same 100,000 going in, same exact investments, but I'm going to take 6,000 out each year. Volatility later. We had the rocket launch. We got all the way up to 250,000, pulling $6,000, a 6% withdrawal rate, and we ended up with more money than we started with. We're pretty happy. We made it through 2008 and 9/11, and we still have more money than we started with. After pulling a 6% withdrawal rate, I'm pretty happy. And if you're intuitive, you're looking at this going, wait a second, I'm doing a 6% withdrawal rate and the investment only averaged 4.61. There's no way I should end up with more money. Yeah, you're right. You're right. But mathematically, this is sound. Because here's the craziest thing. The exact same returns in the opposite order. If you earned the same returns, but in the opposite order, I put the 100,000 in, and I'm in credit cards for $76,000. I ran out of money halfway through this experiment. The exact same investment, just simply in the opposite order. Completely different results. And now the mathematical average was completely meaningless. It didn't represent either portfolio. The day you take $1 out of your investment portfolio, I don't care what the averages are. They mean nothing. You could sit down and show me your buffet of choices of mutual funds, and one says 13, one says 5, one says 2, and I'm not going to go say the 13 is the better investment because I don't know. If you're going to take $1 out of the portfolio, you're changing the math. The average literally means nothing. This one obviously performed better than 4.61% because you have more money and you pulled 6% out. Explain that. It's easy. You had a rocket launch right here. Your withdrawal rate was not 6% when you had $250,000 in there. So then when you started hitting these losses that brought that average back down, you had so much more. You weren't pulling 6%. You were pulling 2%. You were pulling a whole lot of nothing out of there. Okay? So that's important to have that perspective. That changes things when you start seeing this. Volatility is your enemy. And when that volatility hits early in your retirement, holy cow, if you don't have a plan, just pray. Do a lot of praying. Okay? You need a rocket launch to recover from that. Unfortunately, the rocket launch didn't work in that scenario. So here, which is better? This time period, S&P 500 average 7.84. Look, I can come up with fancy, wonderful numbers. And the same investment I just showed you averaged 4%. I told you averaged over 10% the last 15 years. And now I'm showing you 7.84, and they're all the exact same investment. It's because averages are dependent on the time period you're looking at. In these, it's not funny math. It's just arbitrary. That's all it is. It really is. It doesn't matter what part I pick. What matters is the volatility. So if I'm going to invest $100,000, do I want 7% or do I want to earn 3%? You all better said 7% because everybody wants 7% over 3%. But you go to retire. Now the decision's harder. There's your 100,000. I'm going to take 6,000 out every year, and that's 7% running out of money very quickly. Whereas the 3%, you still got several years left. Explain that to me. Here it is. Order of returns. You take that huge dive, that 6% withdrawal rate just turned into a 10% withdrawal rate, because 6,000 from 60,000 is 10%. That portfolio is not going to hang on. You took that deadly hit and you withdrew through that. You exponentially made things worse. You dug yourself into a too deep of a hole and now you can't recover. Okay? We have to learn this lesson. The earlier we learn this lesson, the better off you're going to be in retirement. So, tale of 2 decades. Okay? I want you to look at this. This is what our experience recently has been in the stock market, 2010 to 2020. That decade, I put $1 million in the S&P 500. I took 40,000 out each year to fund my retirement. I ended that decade with triple my money. Plus, I took out 40,000 every single year, so I have $400,000 in my pocket. I tripled my money and I spent $400,000. Okay? So if I retired in 2010, I'm golden. Everything's wonderful. Everything's fantastic. All right? Now, most of us, when we experience this, we don't become all of a sudden frivolous with our money and start buying Ferraris. Most of us built our wealth through being diligent savers and responsible with our money. So just because our money grew doesn't mean that we're going to go spend lots more. We might spend a little more. We've seen some inflation, things cost more. I get all that. That totally makes sense. But we don't just overnight become frivolous. So tripling our money is fantastic. It makes us feel so comfortable and blessed and wonderful, and that's fantastic. But it doesn't mean we're necessarily going to go start spending frivolously. But let's look at the decade before this. You know, I did a video on this. The 2 brothers, one 10 years apart. They retired 10 years apart. One retired in 2010. The other one retired in 2000. And the difference in their worlds. So now we retire in 2000 with $1 million. We're going to take 40,000 out every year, and we have cut our money in half, and we're scared. We're scared at this point. This is the exact same investment, S&P 500. But this is the problem. We hit 9/11, still taking 40 grand out, digging ourselves into a deeper hole. Then we do a little mini rocket launch, but we hit 2008, brought us all the way down to 400,000. Now we're scared. We're pulling a 10% withdrawal rate at that point, and your portfolio will struggle. We are living scared. Okay? So I'm proving to you that losses hurt more than gains help, just like withdrawals hurt more than putting in helps. Losses hurt more than gains help. We have to be careful. If your priority is giving money to your heirs, you might be okay with this. Maybe you have enough income that you don't really need the $40,000 and you can survive, and you'd rather invest this all in the market and you have the chance to grow like it did for that decade, that last decade. Would you risk sacrificing your own retirement to get a chance to give your heirs more money? And some people will answer that, yes, and I'm okay with that. There's nothing wrong with that. I'm not implying there's anything wrong with that, but you have to understand you're playing a little bit of roulette with this, right? The market can keep going up. It can. It doesn't mean it will. We could have another decade like this. Historically, every other decade has had a lot more turbulence. Okay? So as you approach retirement, safe, stable investments should be the core of your portfolio if you're going to rely on it to fund your retirement. You can't control the order of returns. You have to have a place to pull from when the market's not doing well, instead of compounding your losses and locking them in. Losses hurt more than gains help. Deposit into volatility to build wealth. Withdraw from stability to maintain it. So here's your principles. How much of your money goes into safe investments versus stock market investing? Okay. This is your ability to take risks. All right. The higher your dependence on your portfolio, the less it can be left to chance. And the larger your withdrawal rate, the greater the effect of volatility. So these are the statisticians that kind of run the industry. All the computer systems out there are based on this. This is ironclad, black and white statistician, proof that they use in court to defend the big boys. Okay. So on the left here, you have the percentage of your money that you can have in the stock market versus your need for money. This chart really only has age, but that's ridiculous. It has nothing to do with age. It has to do with your need for money. They just built a model person and they assume everybody needs their money in retirement. No, we know that everybody doesn't need their money in retirement. What you will notice here is by the time people get to their full retirement and edging into required minimum distributions, none of these statisticians want more than 40% of your money in the stock market. And that shocks so many people. That's a 40-60 portfolio, not a 60-40 portfolio. I always heard 60-40. Whoa. The statistician that did the 4% withdrawal rate was 50-50 and 40-60. He tested both those portfolios. It's always been 40-60 for people that need their money. But here's how you apply it to your situation. That doesn't mean your portfolio should be 40-60. That's not enough in the market for you. I'm fine with that. Nothing wrong with that. But if I know you're going to need withdrawal income, IRA, your required distributions. If I know you're going to need withdrawal income, I need the 40-60. That's the most efficient historically to handle turbulence. It'll do just fine if the market continues rocketing it up. Okay, it'll do just fine. Everything's going to be okay, but it's going to handle the big downs and the big turbulence way better. Okay, 40% market, 60% in the IRA. Now, the Roth. Hey, I want to give that to my heirs. Great, 100% market. Hey, the after-tax trust money, non-qualified money, maybe a little passive income. Great, dividend portfolio, 100% market. Everybody's in a different situation. This chart can be applied to parts of your portfolio. We're going to treat differently. That's why I put those three different buckets of money, the IRA money, the Roth money, and the after-tax money. We're going to treat those differently. We're going to maximize our efficiency. So remember, deposit into volatility to build that wealth. Withdraw from stability. You need a stable portfolio in order to preserve and maintain your wealth. All right. Build your portfolio one step at a time from the bottom up. The foundation of your retirement is that guaranteed income. Please, please, please make sure it covers all your base living expenses. I promise you that will equal more comfortability in your retirement. There's your foundation. That's the first place you go. Second part is the cash bank account. You're going to use this money. This is not emergency money that you can't use. You're going to use this money every year. You're going to put 1 year's worth of fund money that you don't have covered by that income. And you're going to add a cushion just for an emergency if your car breaks down or if the air conditioner or heater goes out, whatever the case may be. Okay? The bank account is meant to be spent. It's controlling the flow of your money because then the safe and the stock market investments are there to refill that bank account every single year. Okay? And your amount of safe investments versus market-based investments is based on your situation and your needs. Prioritize your IRA to safety as you're heading to retirement. It's counterintuitive, but it's the first place you're going to start pulling money from because if you're smart, you're going to look at that every year and say, how do I get it out at the least amount of taxation possible? That's what you're going to do. Okay? And for some of you, very rarely, that might mean pass it to my heirs. Let them deal with it. For some of you, I'm giving it all to charities. Okay, wonderful. But the vast majority of us, We're going to do little Roth conversions. We're going to help refill our bank account every year, and we're going to be looking at that IRA first, okay? So you're going to want the safe, stable investments in there. And that takes all those interest-bearing investments out of that non-qualified after-tax portfolio. We need less of them there, and they cause higher taxation anyways. So let's get them into the IRA so we don't have to have them elsewhere, okay? And then after you've taken care of your own retirement, then we can start looking at speculative or real estate or estate planning, gold, silver, any of that stuff once you've taken care of yourself. All right, so keeping sight of the big picture, we're going to wrap this up by going through what we have to do at the end of every year. November. I like November because it gives us plenty of time to get required distributions, make any tweaks and changes, Roth conversions. We have plenty of time to get them done before the end of the year. Okay, so once a year, I want you to keep sight of the big picture. Remind yourself that losses come from individual stocks. Losses come from private investing. Losses coming from selling a portfolio at a loss to spend the money. Don't sell investments at a loss to spend the money. This is very specific, to spend the money. Emotional selling without reinvesting. The pandemic was a great example of this. Stock market in a free fall, everybody knew the free fall was coming. We could easily sell our portfolio. But how easy was it to put it all back in? Because when it hit the bottom, it bounced like a racquetball 80%. How much of that 80% did you miss out on? No emotional investing when you're in retirement. There's no reason to. You want to have a play account that you've defined what you can play with. Go for it. I don't have a problem with that. But don't do that as an investment philosophy. Turbulence. Turbulence is okay. Turbulence comes from mutual funds and ETFs. There's no way every stock in there is going to go to zero all at once. And if it does, then the money's not worth anything anyways. The world just ended. That's why we diversify. That's why we buy multiples of different types of investments. Ability to use other savings while waiting for it to rebound. The stock market crashes, I can use my safe, stable investments. I'm going to pull from there for this year because we're refilling that bank account once a year. Adjusting investments instead of reacting. So selling an investment, but not to spend it, to invest it for a better future. Adjusting your portfolio. Selling a stock, the market doesn't know where you bought that stock. If it's down, it may stay down forever. You could be sitting around waiting 20 years for it to come back. The reason you sell that investment is to invest it in a better future. If it's a better investment for you and your situation, sell away. There's nothing wrong with that. We're trying to make it better for your future. Do your annual check-in. Sit down, do your inventory. So remind yourself about the losses and the turbulence. Two different things. Losses are bad, turbulence is fine if you have a plan. Do your inventory, IRA versus Roth versus after tax. Remind yourself you have that equity as that break glass here later in life. You have safe investments, safe, stable investments. Look through your portfolio. Remind yourself, oh, I have all this. So if the stock market's not doing well, we have all this to pull from, and that stock market will eventually come back. 9/11 took a while for it to recover from that. And by the time we were starting to reach recovery, we hit 2008. And then it took 4 years after that to recover. It was a lost decade. You have to have a lot of safe investments to handle a lost decade. Guaranteed income. How much do you have? What are your base bills? Does that guaranteed income pay that base bill bucket? Fund money. How much fund money are we spending? Does it stay within our math? If the math tells us to pull out 40 this year, do we need 40 or do we need more or less? If it's more, we need to fix our problem. Once in a while, no big deal. But all the time is going to be a problem. Refill your savings once that year. You go into your safe investments when the stock market's not doing well. You pull from profits on the stock portfolio. You want to lock in those earnings. That's a better way to put it. It makes you feel better about doing it. No, but it's doing so well. Let it stay in there and keep growing. No, at what point are you going to pull it out? Because the worst time to pull it out is when it's going down. Lock in your savings. Lock in your earnings. Pull that money out from the stock portfolio when it's growing and growing and growing and growing. It's fruitful. You don't look at a fruit tree and say, oh, it's growing. Let's just leave them on there and let them grow more and let them grow more until they go bad. You go pull them when they're ripe and they're juicy and they're good. That's what you do with your stock portfolio. Then do your math. Do your little tweaks at the end of the year. Convert to Roth if you need to. These are all good things. It puts everything back into perspective. It reminds us that we're all in good shape. We can do this. All right, so remember, retirement planning is not just investing your money. Be honest about where you are and where you want to be. Set goals, educate yourself, develop a strategy, inspect what you expect, and consult with knowledgeable, unbiased advisors. Let us know if we can help out in any way. Our next month's topic is the art of income production in retirement. So June topic, June 2025, depending on when you're watching this. We've got 3 opportunities in the summers. We pare it down just to the 3 Zoom classes there. Also, as a reminder, YouTube, jump on there. Just search for planning before investing. All right. It's a great channel. We've got new stuff on there every single week. It's fantastic. Lots of great videos on every single topic I can think of. FPFEAZ.org is the nonprofit website. That's where you'll find the full class schedule. You can register for classes on there, and you'll find the on-demand class of the month on there as well. And yourinvestmentcounselor.com if you want to meet with me for any reason. All right, I hope that helps. Thank you. Thank you so much for attending. And that's it for now. We'll see you next month.